Can you explain the various stages of investment? Okay, so I'm going to give you my perspective on these, the classic seed, A, B, C, etc. Now, I believe if you ask any investor, you're going to get a ton of different answers, but I find this very simple framework exceedingly helpful. Seed is, should this idea even exist in the world? Does it deserve life? And you're basically just trying to prove that it does. And you're going to experiment with customers and design partners and all those sorts of things just to see if it's worth working on. Once you're going to raise your A, you're basically trying to convert those folks to users or paying customers. You're not trying to do them all. You're just trying to see if people are willing to pay you for the value that you're creating. Not just that it's a good idea, but someone's literally willing to give you money for this. And again, you just need proof signals, I think, at the A stage, but you got to have some to that degree. B stage is about building the business. Can I actually build a machine that I can turn this product into increasing value over time? So it's about some of the go-to-market functions. It's about the marketing, the product marketing, the finance. You're trying to understand what efficiencies you have and how much the company understands about its own market, and that you can build an actual machine to keep it going for quite some time. Because when you get into the C stage raise, what that means is, hey, I know how to build this business. I've proven it here. I understand the inner metrics of my business, things like CAC and payback periods and other really boring metrics that investors care about, but they're important because it shows you know how to build a business. Because in the C round, what you're effectively doing is raising money to pour it all over the business, and you expect to get some sort of a pretty expected outcome for the dollars in to dollars out. And so, you should have a pretty good idea that you can put $1 in and get $1.05 out. And that's what the C stage is about. Now, a lot of companies don't necessarily need to go raise a D these days. Maybe you've been efficient enough and you can take the C all the way to IPO. But the D typically is about, hey, we're going to actually take this from a pre-IPO to an IPO round. We're going to increase some of our efficiencies or clean up some of the things internally. We just need to shore up some loose ends and all that sort of stuff. And we're going to maybe pull in some strategics, and that's part of that round. But generally speaking, that's how I kind of think of the seed A, B, C, and Ds. I'm thinking about joining a company with lots of money raised and a big valuation. What should I be considering? Okay, let's break this up into two worlds right now. Exec, non-exec. A lot of the considerations are similar, but I want to get to very specifics in each case. So non-exec first. One, you've got to consider how much runway they have. Like, how much cushion do they have? How comfortable do you feel? What does it look like? We expect that the next little while is going to last somewhere between a year to 2 years. Do you feel comfortable with their cash position and all that? Do you expect to make money off of the options in this company? How do you want to value those? Now, we always say in Silicon Valley, you should value your options at zero. If you're joining a large company that has a very large valuation these days, and their valuation was set in 2021 or 2020, in reality, you're not in the money for a long time. It's going to be a very hard, long road for somebody who has a multiple billion-dollar valuation and a single digit, maybe even low double digits revenue to actually work their way into that valuation. And this typically means for most people that they should be cutting their expectations, if you realistically don't have it at zero, way down by 2, by 3 times, by 4 times. That's just the nature of the game at this point. So, somebody who raised a $2 billion valuation on $1 to $5 million in revenue in 2021, well, there's no world in which they're that valuable these days. And so you're joining underwater in your options already. So how you approach that problem with the company is up to you and the company. Maybe it's getting more options. Maybe it's negotiating a larger equity package. The point being that you can't be doing the math on $2 billion valuation. That's what's holding up in 2023. Now, this is a lot more of a concern for an executive, because executives expect that, yes, they're well compensated from the cash side of the fence, but they're joining a company at that risk profile for some expected future outcome that is all equity based. And so this becomes a much harder math problem for you. So my recommendation is do some market analysis, understand what similarly ARR style companies are actually going for in 2023 market, and really aggressively negotiate your compensation. Now, founders don't like to hear this, but founders, if you raised in 2021 and your valuation at that time was multiple billions of dollars and your revenues were low, you have to have an expectation that people are going to come in and start negotiating for higher equity packages. So whatever you saved on equity in 2021, it's likely that you're paying out equity to employees in 2023.